Hi, everyone. This is Jason Briak of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today, our special guest is Jordan Roy-Byrne, who is a Chartered Market Technician, or CMT, and he's a member of the Market Technicians Association, and he's also the editor of the Daily Gold. Thank you for joining us here today, Jordan.
Hey, Jason. Thanks for having me. It's a real pleasure.
Thank you, Jordan. I'm glad to interview you. We have some interesting things here going on, Jordan, in the general indices of the market. We have the Dow, the S&P 500, and, they've just had amazing gains so far this year. I was wondering your opinion if you think that we're still having a bear market rally or a dead cat bounce or, whatever it is called here from a technical point of view. If you think that's the case, or do you think if Ben Bernanke has managed to financially engineer, a nominal bull market with all of this stimulus and QE after the market collapsed in, 2009, and he was allowed to, start injecting all that money, if you think, he's engineered a nominal bull market?
Well, to give you a quick answer before I delve into it a bit more, I think we're probably nearing the end of a cyclical bull market. We're still in a secular bear, but we're getting as far as a secular bear, I think we could be 2/3 to 3/4 the way through it, and I think the 2009 low there in the S&P at 665 or so, I think that's definitely going to hold. And it's very interesting. If you go back and you look at how secular bear markets evolve, and what I'm talking about here is I think the one that we've had now is the fourth one in the last 110 years or so. The very interesting thing, let's just go back. Okay, some people remember the panic of 1907. After that happened, the market had a rip-roaring rally for a couple years and actually rallied back to within 5% of the high. Now, if you go back to the 1930s, we had that big decline in the middle of the bear market, and I believe it was 37 or 38. The market retraced 62% of the losses. Now, if you go back to the 70s, the big decline in the middle came in 1974-75. But a couple of years later, the market rallied and was actually, I believe, within 5% of the previous high. So leading up to this, we have three examples in history, and two of them in the middle, after the crash in the middle of the bear market. In two of those three examples, the market actually recovered 95% of the losses. Now, in the Great Depression, it recovered 62% of the losses. So where we are now, looking at the S&P, it's at 1370. The highs are 1570 something. So and I think it's tending to follow those two examples and not what we saw in the 1930s. So what's really happening is the market is following history. And, looking at the market, I have a hard time seeing the S&P go much higher than 1450. But for now, I think in the short term that we may see a correction of some sorts. But I think the trend is still higher. But we're not going to break to new highs. So if you have a 2-year time frame or so, conventional stocks are not going to break to new highs. They still have a little bit more upside, but they're nearing very, very strong resistance. So if you look at what's happened in a historical context, it's not out of line, which happened in two of the previous three bear markets. And I'll also add, something we have to think about. Markets, the indexes have a survivorship bias where as you know, as time goes on, the weak companies are replaced by stronger companies. The S&P or the Dow from 1930, none of those companies are still around. So when the market has a survivorship bias, which is why it tends to, it gives it kind of added strength over time. And to go more into that point, we've had two really bad recessions in the last 10 years. And so the private sector companies that are still around and doing well, they've think of the phrase, what doesn't kill you makes you stronger. So a lot of these companies, the 500 companies in the S&P or the companies in the Dow, these companies have weathered two very bad recessions in the last 10 years. And that's something that we have to keep in mind. And so those are, I think, the reasons why the market has had, or at least in my opinion, that's what I point to try to explain why the market has had such a strong rally. And just to kind of finish my answer, the last phase, the end of a secular bear market, what you see is you tend to see a mild cyclical bear market where, because looking at a secular bear market, there's so much volatility in both directions. And then when you kind of get to the last third of it or the last quarter of it or so, you have some people who are, the market's had a nice rally, so of course you have the perma bulls who are saying it's going to break to a new high, it's going to go up, and then you have the perma bears who are saying, oh no, we're going to crash again. But no, what actually happens is you kind of have a mild cyclical bear market for, 2 or 3 or 4 years where the market kind of trends sideways and has a downward bias. So that's over the next several years. I think that's kind of what I'm looking for. And in that period, what you tend to have is you have, inflation starts to pick up, interest rates rise, and so that's what hurts profit margins. Higher borrowing costs, higher costs because of inflation, and then the government usually it tends to be a government-led recession. The market forces the government to cut back. So I know that's a long-winded answer, but I hope that covered it.
Yeah, you gave a very detailed explanation. So I think what our listeners can take away is you expect this as a bear market rally, then you don't see, a real fundamental bull market case then developing then out of these indices where, they're really actually growing their sales volume a lot, their profit margins are expanding, et cetera then.
Right. Well, I mean, from a technical point of view, we have very strong resistance on the S&P at 1570 or so, and I don't see that breaking to the upside. And for something to be in a real secular bull market, it has to be the only thing that's going up. I mean, we're in a commodity bull market, and we're in emerging markets are also in a bull market. So there's other things that are in a bull market. And money is moving into those areas, and that's why the S&P is not going to break to a new high. But for it to start the next bull market, valuations are going to come down. So I'm not necessarily a super bear on the economy. I think over the next 3 or 4 years or so, companies can continue to grow their earnings, but I think valuations will compress because that's generally what you see in that last phase as I was talking about.
Yeah, and I also see, that gold and oil are, continuing, maybe they're consolidating a little bit here, especially gold, but, I'm just seeing a higher oil price, and I don't know how some of these companies are going to continue to make, really good money and also maintain their profit margins when the oil price is just continuing to go higher and higher. I see like the oil price, affecting the business cycle.
I agree with you. That's one of the things that's going to start to cut into the profits of these companies. I mean, you're looking at oil. Looks like it's about $107 on light sweet crude. And, looking at the technicals on that chart, there is some resistance at 110, 114 or so. So we could trend up a little bit more, and then I think we'll probably see a correction. But if we see oil break above 114, then there's really very limited resistance until the old high up there at 147 or whatever it was. So that's definitely a worry. And as you know, the rise we've never, or I should say, it seems like every recession we've had we've always had a high oil price. So again, if we see oil making a new breakout past the high of last year at 114 or 115, I think that's definitely not going to be good for the market. And if we see again, that's that can coincide with the technical resistance we're seeing on the S&P. It could trend up a little bit more, but boy, there's an awful lot of strong resistance there, 1450, 1500, etc. And there you go. Oil is one fundamental reason why the market's not going to break those levels.
Yeah, and I think at this stage, the major indices have already gone up so much. I think oil is a lot better bet to head higher, especially, with the stuff going on potentially in Iran in the next 6 months. And, there's just been some drop-off in production from some of these larger oil fields are depleted, like ExxonMobil in the last couple quarters. Their oil production has fallen off quite a bit. So I think some of these things are starting to be priced into the oil price, and it's not looking, good for cheap oil, cheap gasoline, et cetera, et cetera. What type of price action do you think an Iran-type event could lead then to the oil price, in the next 6 months, what type of spike do you think we could see if we have like some sort of announcement about, the U.S. and Israel going into Iran?
Well, looking at the chart, I would say, we got to focus on that 114 level. That was the high in 2011. And again, if we break that level, then I think oil, there's limited resistance until it gets back to 148, the old high. So I'd say the old high. But Jason, let me play devil's advocate, because I think it's really in no one's interest for there to be for us to bomb Iran, or for there to be another war. And the reason I say that is because high oil is bad for everybody. The only one it really Iran has a regime that's been weakening for years, and I think in that type of situation, the only party it benefits is actually the leadership of Iran, to kind of make a contrarian answer there. So I think the people that are making these decisions, I think they have to realize that there would be very severe economic consequences. And also, if you look at the sentiment on oil, there's a lot of speculative bets in the energy complex. So a lot of speculators are they've bid up the price in anticipation of something happening. So, and I'm not saying this is going to happen, but if you want to be a contrarian then I would. I'm not going to say I'm bearish on oil, but I think I don't really see it spiking. I don't see an event with Iran happening. We also have an election coming up. There's a lot of elections going on around the world this year, so I really don't think it's in anyone's interest for oil to move much higher. And given that a lot of speculative money has come in the last 6 months or so, I don't see it moving above 114, 115.
Those are some great points, Jordan. And to add more to your argument here, I think what's happening in the oil markets is, everyone, like you said, does not want a super spike. Before, some of these potential Iran news was coming out about, the U.S. and Israel preparing for, to go into Iran, I was just expecting I was just expecting the oil price to have basically, a trading range, maybe a little bit higher trading range. And I don't think it's in OPEC's interest. I don't think it's in Saudi Arabia's interest for a price spike, because, if oil prices go to 130 or higher and stay there, a lot of the the alternatives, some of the better advanced biofuels projects, like algae ethanol and cellulose ethanol, et cetera, geothermal, these things are going to become, very economic then, gas to liquid technology too, where, natural gas prices is lagging so much, it's going to be cheaper just to turn that natural gas then into synthetic biodiesel and sell it into the market then. But, it's really interesting to see some of the speculative money that's just been going into oil lately. And an oil price spike, it would be just so inflationary on the whole economy, because, oil is the lifeblood of the economy. It's the master resource. Pretty much everything that is produced is made from oil. I just don't see any of the companies then being able to maintain their profit margins with a much higher oil price.
No, I completely agree with you. And again, that's just why I kind of, well, let me just say, price action wise, the chart on oil is bullish. So I'm looking for resistance at 114 and also 120. I was just looking at it for a second. I don't see it going above those levels. The price action is bullish, but looking at sentiment, I think sentiment is too bullish, and so that's kind of why I gave my contrarian answer. And I mean, to your point there, companies don't want to see a spike in oil, or even oil going above 120. I don't know.
Now, Jordan, I want to transition from oil to gold here. It looked like we had a false breakout, I guess you technicians would say then, in gold and silver, because, I'm not a CMT, but I do know some basic technical analysis pretty well, and it looked to me on the charts like last week that gold and silver, broke key overhead resistance levels on strong volume. Doesn't that normally, signal a very strong breakout is coming?
It does, and if you draw a trend line from September, kind of the middle of September, before the price really started coming down, you draw a trend line. It appeared that the market had broken that trend line. And the very interesting thing about gold and silver and precious metals in general is there's numerous false breakouts and breakdowns. It happens all the time. I mean, multiple times every year. One example of that, go back to December. In December, a couple weeks before Christmas, the gold market broke below 1,600, and some technicians would call that a breakdown. It had a little bit of a rally to 1,645 or so, and then it went all the way down to 1,525, and so that would appear to be a breakdown. Yet, since when it made the low that day, it just zoomed right back up, and all the way to almost 1,800. So there's a lot of false breakouts and false breakdowns in this market, and to me, gold is just falling back into a consolidation. Looking at it, gold has resistance at 1,800, has very strong support at 1,575 to 1,600, but it also has pretty good support around 1,625 and 1,650. And looking at gold the last couple of days, it's had a pretty good rebound after it bottomed at about 1,670. I think it closed at about 1,711 today, if I'm looking at the right day. So I'm kind of – the precious metals are a little bit tricky to me here over the next couple of weeks or so. Moving further out, I think we're in a consolidation. So that's kind of my view. Looking at gold, it's going to have resistance at 1,800, and initial support right now is at about 1,670, and there's also strong support at 1,625. And we're in the 6th or 7th month of this consolidation. So I'm not terribly worried about gold, and I'm not trying to time everything. I would just say it's probably going to take at least a couple months before we break past 1,800, and if the market moves down to that support, then that's where you want to accumulate.
Aren't consolidation patterns, like I know you said that we're not at the bottom of like this consolidation pattern, but aren't consolidation patterns normally a good time to add to positions or to start positions for gold, silver, or some of the mining shares?
Absolutely. And as I was saying, in a consolidation, the market usually identifies support and resistance. And what the interesting thing is, if you go back to 2006 and 2007, we had a fairly long consolidation there, and I think we're following a similar pattern. Back then, it took more than a year. The consolidation, I believe, lasted more than a year, so it took months for the market to actually break out. Though the low in terms of price came, 5 or 6 months into that consolidation. So I don't see us testing 1550. I think we might test 1625 or 1650, but I don't see that happening. And so it in this consolidation, it is kind of tricky. I mean, looking at where gold is right now, is it going to rally back to 1800 in this month, or is it going to test 1625? I honestly can't tell you. It would just be a guess. All I can say is, if we do see weakness, that's when you want to accumulate, and you don't want to have expectations that the market is going to make a breakout real soon, because I don't see that happening. It's just going to take more time, and so perhaps we see a breakout at the end of the summer, which is always a seasonally strong time of year.
Yeah, and I think that's a good approach, Jordan. And I think there could be some news-driven stuff that could come out and maybe potentially, push it over the overhead resistance levels again, because I think, Greece, I think the market was thinking, that some of this stuff would get resolved in a pretty efficient way, but right now it looks like some of the news that just came out, there's now an ISDA credit event for Greece, which means, credit default swaps could get possibly triggered. That could create a domino effect here. Not sure exactly, what that would do to the gold price, but some people are going to want to go to the dollar then, or treasuries, and then some people are going to say, they're going to look at the fundamentals long-term of the dollar and treasuries and say, I'm not going to put a humongous amount of money in there. I'm going to put more money into gold instead.
Well, if I can just touch on treasuries quickly, treasuries have kind of been in a consolidation since, well, it depends which treasury you're looking at, but if you look at the TLT, which is a 20-year ETF bond fund, that actually made its high in September, and that's been consolidating, but in a bearish fashion, and it looks like it could start to make some new lows in the next couple months. So treasuries, to me, I don't see them making a new high, and so that's bullish for commodities and risk assets in general. And looking at the dollar, the dollar itself is interesting because I believe that commodities and precious metals tend to lead the dollar. So that's why I don't place a huge importance on the dollar. I know that may kind of sound blasphemous to some people, but if you go back the last couple of years, the commodities market has been leading the turn in the currency market, and as you and I both know, gold has done fairly well at times when the dollar has been rallying. So the way I look at it is I tend to have currencies kind of being a secondary indicator, yet when we do see the dollar showing significant strength, that's definitely a warning sign for commodities and precious metals. But look, the interesting thing about the dollar is it's held up very well against the euro. But if you measure the dollar against a lot of the other currencies in the world, I believe it's trading near its lows. So it's very, very difficult to get a handle on the dollar when the dollar index is basically the inverse of the euro, and the euro is also having significant problems. Yet, if you look at the dollar against the other currencies, as I said, it's been performing pretty poorly, and I believe it's near its lows. So, to kind of make another point, because of these relationships, there can be a lot of noise in the currency market, and that's why I use the dollar euro as secondary indicators of sorts.
Those are some great points, Jordan, and like the normal conventional thinking is that, the gold commodities are contra assets to the dollar. But I've seen a lot of research, and Jim Rogers is one of the main proponents of this. One of the main, people who goes on interviews and talks about this is the dollar and gold don't have to go in opposite directions all the time. Because, when there's perceived, problems in the world, there's just so much money floating around, all this hot money, momentum money, large pools of capital, it all can't go into gold at once. So, I really think that for my perspective, I think the dollar and the dollar index could be pretty solid because, like you said, it's compared to just the euro really on the dollar index, whereas the dollar is getting its butt kicked against a lot of, commodities, against foreign currencies. And I think gold's going to hold up pretty strong, too, because gold's, it's not going to get destroyed. I think gold's going to, at worst, stay in a consolidation pattern. But, if we have the right type of news story, I think we could have a pretty big breakout in gold. I wanted to ask you, then, your opinion about the mining stocks. If you think, then, that some of these miners, like some of these small junior producers or some of these mid-tier producers, because they see a consolidation, but they do have higher expectations for prices, if you think they're going to be aggressive during this consolidation phase in the actual metal prices and go out and do those, M&A deals?
Well, that's a great question, and in regards to the miners themselves, I feel like it's a very, very tricky situation right now. I mean, looking at the GDX or the HUI, they've failed to get above the 300 and 400-day moving average, so that's very bearish. Yet the market hasn't broken to a new low, but the price action looks very poor. Yet on the other hand, SentimentTrader.com, which is a great service I use for sentiment in a lot of markets, they have an indicator looking at the equity sectors. It's based on a combination of put-call ratio, short interest, and analyst expectations. And their sentiment indicator for the gold stocks is now back in an extreme bearish position. So that's, for you contrarians out there, that's very bullish. So to kind of summarize, I don't like the price action in the mining stocks. I don't see a ton of downside, though, based on the negative sentiment. And at the same time, I don't see, looking at the GDX, it does have resistance at 58. I don't see the market breaking through 58 in the next month or two. But I could be wrong, so that's kind of a circuitous answer there. But that's my feeling. It's a tricky situation. And the other thing with these indexes is there's some stocks in these indexes which are polluting the indexes. I mean, Kinross Gold, that's fallen from 18 to 10. I mean, it looks much better.
Massive dilution. Yeah.
Agnico Eagle is another stock that people have loved for many years. In the last year, it's fallen from 85 down to now it's at 36. I mean, so there's stocks like that are polluting the index, and these stocks have gone down because of their own operational problems and not because not because of negative fundamentals for the gold stocks, yet they drag down the index. And, I mean, Newmont Gold, that's another example. I mean, Newmont is at the same price it was, I think, in 1996. So these indexes looking at the stocks, it's very difficult to get a handle on what's really happening because these individual companies can, their negative performance, which is not related to the sector itself, can pollute the index and kind of throw you off. So those are my feelings on that. And as far as consolidation, I think the interesting thing about consolidation, you and I, we talked about it a couple of years ago. I think there's going to be more consolidation in the silver patch, actually. I'm looking at some junior explorers and developers in Mexico, and I think companies like Fortuna Silver and Endeavor Silver, they're going to need to make some acquisitions to continue to grow. First Majestic, they have the projects in their pipeline to continue to grow, but I think we're going to see some more consolidation in silver, and in regards to the gold companies, it'll be interesting to see what happens. I mean, we have seen some more acquisitions, but I don't have a strong opinion on that presently. I mean, I do feel as the bull market moves on, these companies are going to have to make more acquisitions. Another thing the large companies are doing is they're starting to pay dividends, and I think that's a smart move. That's going to attract more new investors. So they may be looking to pay more dividends rather than make acquisitions.
Those are some good points, Jordan. And in talking with the CEOs of some of these, mid-tier producers, like I've spoken with First Majestic Silver CEO Keith Neumeyer a little bit, and, it really seems like he didn't want to comment that much on actual acquisitions, but these guys are expecting, the prices to go higher, in the next 18 to 24 months, and that will make it more likely, them more aggressive to want to actually do some more deals. Although, if they do have the organic growth profile, like a First Majestic Silver, they don't have to go out and force anything and go out and overpay and do a bad acquisition like some of these other miners have done, so they can just sit back and wait for the right opportunity, I guess.
Right, I would agree with that. And what one company told me, what their acquisition philosophy is 1 + 1 = 3. So I think a lot of these companies, I mean, to us investors, we were too quick to assume, this is going to be a takeover, or this will be taken over. But these larger companies that do have to make acquisitions, they have to be very, very diligent. They have to do their due diligence because this is a very difficult business. And if they make a bad acquisition, I mean, that can lead to the end of their career, basically. And so just going back to that point, I think what companies want to see with acquisitions, they don't just want to buy someone to get bigger. They want to buy it because A, they can get bigger, but B, whatever they're buying, the company or a project, they believe it has more upside, than what they would buy it for presently. So, I think those are some reasons why we haven't seen more acquisitions. The companies, I mean, they have to be very conservative, and it's a risky business. So the strong companies out there, they're not just going to go make acquisitions willy-nilly. They're really going to take their time. They want to find something at the right price, and they want to find something that has upside. So I think it's more about that than just trying to get bigger and trying to please the market and show them more growth.
And those are some excellent points, Jordan. And to add to your points further, to give our listeners an example of, the due diligence required on some of these acquisitions, going back and listening to the Pan American Silver acquisition of Minefinders, they spent over a year talking to each other and doing due diligence on things to see, not only was Pan American Silver buying accretive production, but that the mine that Minefinders had at Dolores could be, more fully optimized, so it could produce more silver, more reserves could be found, et cetera, et cetera. So, this is a very extensive process, and I think that's why there's been a delay in some of the M&A activity. But, the producers, the larger producers now, a lot of them have not done a very good job, in my opinion, of replacing reserves. They're pulling, silver out of the ground, making good profits, good production, good cash flow, profit margins are expanding, but they're not replacing reserves as fast as I'd like them to. And I think eventually, for the long-term health of the company, they're going to have to go and replace those reserves because, with commodity companies, it's a different animal there. Unlike other business models, they have to fear depletion.
Right. I mean, you're exactly right about that.
Okay, well, I think this was a great discussion, Jordan. In wrapping things up here, can you tell our listeners about the Daily Gold and some of your services that you offer over there?
Well, I have a free newsletter, and I also have a premium newsletter called the Daily Gold Premium. It's a pretty intense coverage on gold and silver. I like to say we focus on market timing and stock selection, and also I have an add-on service called the Daily Gold Global, where twice a month I give updates on kind of the macro situation, what's going on with emerging markets, bonds, other commodities, etc. And that's basically the work I do. I mean, I have more of a technical approach, but I do also look at fundamentals and sentiment. And, so there you have it. That's what I do. And if you want to sign up, there's a link on my website you should be able to find.
And I just want to thank you for the opportunity to interview and for your time, and hopefully we'll have you back on here very soon to talk more about the gold, silver markets and other related macro events.
Hey, Jason, thanks so much. It was a pleasure. I look forward to speaking with you in the future.